Good morning. It's Tuesday, the 2nd of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's rainy financial capital. The take: Indians are spending more money overseas than ever. They should not be constrained. Well, so Indians are spending more money overseas than ever. A lot of it is on travel. The money spent has risen from about $1 billion 10 years ago to about $31 billion today. Now, the way the figures look, it also suggests to me that there is some miscounting happening or undercounting for historical reasons or maybe current reasons. By the way, remittances coming to India has also hit a $120 billion mark, a new high. This is roughly the gross figure. The net comes closer to $107 billion, which is, of course, a high too. Now, the government has been responding to this rising trend of overseas spends with 1970s-like laws, including a presumptive tax on credit card spends overseas and a campaign to host weddings or rather move weddings that you may potentially host overseas to India. Indian spend on overseas education is rising too as more students go overseas. If that figure comes down, that is of students going overseas, it's because countries like Canada and Australia are putting the brakes on overseas students, large numbers of whom come from countries like India and China because they are seeing pressure on local housing and thus they're calibrating the number of student visas that they give out. Back to overseas travel, for which there is no real curb, the obvious question is, why do people travel overseas so much? For one, the kind of people is shifting constantly. Wealth is constantly being redistributed across India far more widely than ever before, and people from smaller cities who may not have traveled much overseas earlier are doing so now, which is, of course, a very good thing. Also, there's increased direct connectivity from, let's say, Middle Eastern airports to smaller cities in India. And airlines like Emirates flies to 9 airports in India, or from them, Qatar Airways flies to 13 destinations in India, including Nagpur, Amritsar, and Goa. So apart from the fun of visiting new places and destinations and satisfying a certain travel lust, a key reason is cost. Whether for family holidays or destination weddings, India's tourism unfortunately has inflated itself beyond reach. For some time now, Indian tourists have preferred to fly to Phuket, let's say in Thailand, which now has direct flights from cities like Mumbai, or Bali in Indonesia, which again has direct flights from Delhi. Then, let's say Goa, where good hotels usually quote in the 15 to 20,000 per night range in the best of times. Don't even ask what they quote like in peak season. So the government's response has been to dissuade people from going overseas by imposing taxes of some sort or by imploring them not to go there. Experience over decades shows that Indians usually find a way to do things they want to, taxes or not. And the lesson of the last 2 decades equally is to offer the freedom to choose. Indians will fly to more, let's say, spiritual destinations in India if they desire to, as they clearly have been. Equally, younger couples may want to get married in an exotic overseas beach destination so it's memorable for them. And we should not stop them. And the government should not, even by suggestion, try to tell people where to go or not. It can surely remind people of the wonderful destinations there are in this country as there are. But then, it should focus on the sheer costs and why hotels in India are so expensive. The tax system is set up in such a way that goods and service tax on rooms of tariff of 7,500 rupees per night and above is 28%, which is the peak level, while rooms between 2,500 and 7,500 rupees are at 18% and so on. Now, no one is saying 5-star hotels are not a luxury, but rupees 7,500 and above is now way below 5-star levels. But policymakers can surely see the unintended consequences here because the return for investment or on investment in a holiday is not seen as favorable. Because a holiday is not just what you experience inside the 4 walls of a hotel or resort, but the whole experience of it. The larger point was, of course, expenditures going up overseas. That figure should trigger a look on how to make it attractive to stay in India or get married here. When I say attractive, I obviously mean financially attractive. Equally, imposing presumptive taxes on credit card spends overseas is a bad idea, and quite likely India is the only country in the world that does it. A free market for movement of tourists will automatically balance out over time as people weigh all their options without the restraints as we are imposing now. The government should equally make it easier for overseas tourists to visit India and spend here, which again they will only do if India is the most attractive destination or a more attractive destination, including from a cost point of view, unless people want to specifically visit the palaces of Jaipur or the Taj Mahal. Now, those numbers I can tell you are not increasing right now for various reasons. A holistic view is quite critical, therefore, for dollars coming in and fewer dollars going out, as that evidently seems to be the objective. Okay, here go the top stories and themes for the day. The stock markets hit fresh highs. Almost forgotten IT stocks like Wipro are moving now. The monsoons are set to revive in July after a bad June showing. Indian electric two-wheeler sales are stagnating even as the world sees excess lithium supply. And garment exports could benefit from production-linked incentives. Can the industry take advantage?
This is a core report with Govindraj Ethiraj.
The markets hit highs, old favorites return. The stock markets hit fresh highs as the week began. Let's get the numbers out of the way. The BSE Sensex gained 443 points to end at 79,476, while the Nifty 50 closed at 24,142, up 131 points. As you can see, the Sensex is in breathing distance of 80,000 and the Nifty of 25,000. Most major stocks continue to rule, including ITC, Tata Motors, HDFC Bank, Infosys, Hindustan Unilever, and Ultratech Cement, which of course cements the rising flows into legacy and large cap stocks by institutional investors, including foreign portfolio ones. Of course, the broader indices continue to move faster than the benchmarks. The BSE MidCap index, for instance, ended about 1.1% higher, hitting a new lifetime high of 46,696. The BSE SmallCap index too ended about 1.6% higher, close to its record high of 52,976 hit in intraday trade. So once again, despite all the fears expressed by all veterans and regulators in recent months, money has come gushing back to small cap stocks, which is where most opportunistic money would go in any case, because investors would tend to think that large caps are well researched, institutionally invested in, and thus more expensive, which they are, even in real rupee terms. Wipro gets an upgrade. For some time and for various reasons, Wipro as a stock was written off, as was the company from a stock point of view, with the conclusion that it was unlikely to grow much or grow fast like the rest of the IT services industry, which was struggling to show growth in a tight environment of lower IT spending in the West, including in the United States. And then there are the challenges of what artificial intelligence can and will do to IT services companies. So while Wipro, like other IT services companies, are now fighting back or trying to, interestingly, the stock market is also viewing them with fresh, what I can say, love. Money Control reports that a double upgrade by broking firm CLSA sent shares of Wipro higher by as much as 4% on July 1st, making it the top Sensex gainer, with a rating revised from underperform to outperform, and the target price raised from 431 rupees per share to 607 rupees per share. And that means that there is a potential upside of nearly 41%. Now, it's not that the growth expectation is great, because CLSA thinks Wipro will give a second quarter revenue growth guidance in the range of 0 to 2%, that's in dollar terms. But the fact is that there are contracts flowing in. One example which caught or seemingly caught the market's fancy was Wipro's announcement of a contract worth $500 million spread over 5 years. The fact that Wipro secured this size of a contract in this case from a communications services provider, which could be a telecom company, at a time like this was seen as a positive. Elsewhere, several large cap, including in IT services and in consumer product stocks, as we've been pointing out, are being revisited. To the extent that it reflects a business turnaround for these companies and these sectors, I guess that's welcome news. India's monsoons could revive after a bad June showing. Not so welcome news for all the projections earlier. June was a bad year for a monsoon season that was supposed to begin robustly. Now, this has obviously had a direct impact on food inflation, made worse by the heat waves and prices, among other things, of tops, that's tomatoes, onions, and potatoes. India is now likely to receive above average rainfall in July, after receiving 11% below average in June, according to the Indian Meteorological Department on Monday. All regions except northeastern states are likely to receive rainfall equating to more than 106% of the 50-year average in July, according to the chief of the Indian Meteorological Department in a virtual news conference reported by Reuters. IMD data said that India received 11% less rainfall than normal in June, as all regions except the south of India received below average rains after the monsoon lost momentum in mid-June. The southern region received 14% above average rainfall. So watch this space for more updates as they come, including on the specific impact of the falling rainfall levels last month. Saudi goes for big gas projects. Saudi Aramco has awarded construction contracts worth $25 billion for the development of its Jafurah gas project as it looks to boost gas production, according to Bloomberg. The contracts awarded include about $12 billion for increasing gas output at Jafurah and about $9 billion for expanding its so-called master gas system, which delivers natural gas to customers across the country. Saudi Arabia, incidentally, has some of the biggest gas reserves in the world, and the Jafurah field is estimated to hold 200 trillion cubic feet of gas. Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. The world is looking at lithium oversupply. There is much talk of gigafactories coming up, including in India, to manufacture electric batteries which go into cars and two-wheelers, among others. But the problem is, lithium is seeing a supply increase and demand go down. Argentina, for example, will see 4 new projects that will produce lithium in the weeks and months ahead, according to a yet-to-be-released federal government timeline seen by Bloomberg News. Now, that will almost double production capacity in Argentina, whose growth potential, according to Bloomberg, has lured the attention of battery makers around the world. And yet, says Bloomberg, for global lithium markets, the extra production comes at a time when buyers are already well supplied, with inventories piling up amidst a gloomy outlook for electric vehicle demand. Spot prices of lithium carbonate in China have already slid to the lowest since August 2021. Argentina is now a major lithium producer behind Australia, neighboring Chile and China, says Bloomberg. It also points out that while the new capacity won't be all used straight away, it nevertheless represents a significant overhang in a market in which global production is estimated at around 1.4 million tons this year. And speaking of lithium and electric, sales of electric two-wheelers remained flat during the first quarter, that's April to June of the current financial year, at about 222,000, according to government data reported by Money Control. Total electric two-wheeler registrations were up only about 1.6% from the same period last year. Industry players said this was because of the reduction in subsidies which were given to electric vehicles by the government, which replaced its policy for this, which is called FAME 2, and came up with a new one called the Electric Mobility Promotion Scheme. The new scheme, valid from April 1st to July 31st, offers a maximum subsidy of 10,000 rupees per electric two-wheeler or 5,000 rupees per kilowatt hour of battery capacity, which is lower. These figures were much higher earlier. Could India's garment exports industry get a leg up with PLIs? Last week, India's Textiles Ministry said the government had approved a 10,000 crore rupee production-linked incentive scheme for textiles and was now considering extending it to the garments sector with a view to boosting domestic manufacturing as well as exports. The scheme would run over 5 years and promote production of man-made fiber apparel, man-made fiber fabrics, and products of technical textiles in the country to enable the industry to achieve size and scale and become competitive. Technical textiles are those textiles which are used for a specific purpose, for example, umbrella cloth. India's textiles industry is worth about $165 billion, and we have to take it to about $350 billion, the Minister for Textiles said. I reached out to Mithileshwar Thakur, Secretary General of the Apparel Export Promotion Council, the official body of apparel exporters in the country. The AEPC has roughly 8,000 members and represents over $16 billion in exports. One key problem for Indian garments and manufacturers is, of course, scale. The average number of machines in an Indian garment factory is about 250 to 400, while internationally the average is closer to 1,000. There are some very good, completely flawed policy reasons for this from the past. The question, of course, is, can it be reversed? I began by asking Mr. Thakur how he was seeing the possibility of PLIs working in this space and whether it would help the somewhat dispersed garments industry and where it could benefit and whether this would help India become more competitive.
The challenge that this industry faces is in regard to, I would say, scaling, and I think technology interventions, right? Scaling has been a big challenge because our average size of machines in India is around 250 to 400, as against the global average of around 1,000 machines. So scaling is the need of the hour, also to stay very competitive in the market. And you know that why this PLI scheme came, and let me touch upon that. See, the problem is that India has been primarily a cotton-centric nation, right? See, globally, the cotton and non-cotton proportion is quite different from what you have in India. In India, it is 60-40, 60 cotton, 40 non-cotton, as against, 28 is to 72 the rest of the world. Because the world is, moving towards what you call MMF-based garments because of the durability, the flexibility, the versatility of the fiber. You have all kinds of fashion wear or formal wear or sports wear now in, MMF-based. So that is where we are logging.
Handmade fibers, right? So
We have enough of MMF fiber, but then we didn't have, we are not strong in MMF fiber-based garments, right? Because if you talk about fiber, I think we are sitting on a massive MMF fiber infrastructure. We are number 2 in polyester, I think number 3 in viscose, and almost number 4 in nylon acrylic. There are 4 major man-made fibers: polyester, acrylic, nylon, and viscose, right? Polyester and viscose itself, they account for around more than 95% of the entire share of the MMF fiber. But we have problem with MMF-based garments, right? So that is where we're lagging. And what was happening was that was impacting our capacity utilization because we were not able to use our machine to the fullest because we were essentially catering to summer wear, right? So that was one issue. And then again, there was some kind of disconnect between what India was exporting and the world was demanding. We were not in sync with the global demand because global demand was gradually shifting to MMF-based products where we were essentially cotton-centric. So there was a need to boost production of MMF-based fabric and MMF-based garments. And the government's selection of the products for the, textile PLI has been on the dot. So the idea was to basically boost production and manufacturing of MMF garments and fabric. So PLI came for that. And that is where we stand right now. So,
yeah. So at this point, how many companies, if any, have taken it up already?
see, to be very frank, the response has been less than great. I mean, I would say it is lukewarm because only 64 applications have been approved. I think some 67 odd entities had applied. Only 64 have been approved. So we were expecting greater response, but it has not come. From garment industry side, I think we have been demanding a couple of things. One, we were demanding that we should have a PLI 2.0, which should be for all kinds of garments, irrespective of the fiber. And at the lower investment threshold, right now, there are 2 windows of investment. One is 100 crore, the other is 300 crore. The problem with garment industry is that it is largely dominated by MSMEs. So not many players had the financial muscle basically to make that kind of investment. So we had suggested PLI 2.0, which had windows like 15 crore, 30 crore, all of that. So that's what it was. But in the current scheme, of course, I'll give you the data, is the proposed investment is by 64 applicants is around 19,000, some 798 crores. And that would generate some kind of a turnover to the extent of some 1,93,926 crores.
Got it. Okay. So now the 64 applicants who've put in, is it only scale expansion, which you referred to when at the outset, or is it like any specific areas which even the government would like them to do?
No, see, PLI for 3 things. One is for MMF garment, then you have MMF fabric, and then you have technical textiles. Textile textiles also is an upcoming area where there's a lot of potential. We believe that this PLI 1.0 was not designed for, garment industry because we did not have major players to make that kind of investment. So we wanted smaller PLI, 15 crore, 30 crore, all that. And I'll give you a very interesting statistics that if you make an investment only in plant investment, 50 crore, I think then you are able to have some 1,000 machines, which will employ around 1,800 to 2,000 workers. So the employment ratio per crore here, I think if you only talk of investment in plant and machinery, is almost 120 persons per crore, which is phenomenal. In the average industry scenario is that you are able to employ some 7 persons per crore of investment, right? So employment potential, as you know, in the sector is humongous. And so 15 crore investment, some 1,000 machines, 2,000 employed people, and you're able to generate some 150 crore turnover in a year. And if that machine has a longevity of, say, 10 years, then it would be resulting in some 1,500 crores. So, 100x, basically.
So, if I can ask you a slightly broad question. So, assuming, let's say, some of these projects are fruitful, as in where companies go from the average of 200 to 300 machines to, let's say, 1,000 machines, and they're also focusing on some of these areas, would, let's say, India become more competitive than some of the other countries, including in Asia, that we're competing with in a broad sense?
Disadvantages from 2, 3 perspectives. One is the economy of scale. That point will definitely be addressed through this investment. There are certain other areas like, say, countries like Bangladesh. Now they have a duty-free access. By virtue of being, LDC, they enjoy duty-free access to European Union and all, which like we don't enjoy. But I think we are already negotiating FTA with European Union and UK. And once that deal is inked, I believe, then we will also have zero duty access, and we'll have a level playing field in that sense. Another area of Bangladesh advantage, of course, is being LDC. They can give some prohibited subsidies we can't give, but we don't believe in deriving competitiveness from subsidy. We want that our competitiveness is to derive from the technology interventions, Industry 4.0, through improving productivity and a whole lot of that.
When do you see, let's say, the first factories that use this PLI to expand capacity really taking off in terms of actual manufacturing?
You are talking about PLI 1.0.
I mean, whatever is currently open right now and companies are bidding or pitching for.
Very shortly, see, the point is, I tell you, when the investment was allowed in, the scheme was allowed in 2021, there were 2 years of gestation period given, right? 20 to 23 and 23-24. So 24-25, they were supposed to actually generate turnover, and this incentive was supposed to come from 25-26. So I think in the year financially 24-25, we expect, some of these units basically manufacturing and making sales, whether it is domestic or exports. Yes. So the station is over.
Right, Mr. Thakur, thank you so much for joining me.
Thank you so much. My pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.